Hello and welcome to Brainstorm. I am your host today, Craig Birchall, and I'm with two very special guests. I'm with Asaf Iram, who is the co-founder and chief risk officer at Bitpulse, a risk management engine solution for institutions in the digital asset space, and Mihai Popa, who is the head of risk analytics at CorPrime, a crypto prime of primes. Gentlemen, it is great to have you today.
Great to be here.
Thank you.
It is. We've known each other for a little while, but I think it would be helpful for the audience, just very briefly, to hear a little bit about what you're doing at both Bitpulse and CorPrime.
Yeah, so we basically built a risk engine that works in real time, and it's very scalable, that allows our clients to underwrite assets as collateral, define the right LTVs, get probabilities of different events for the portfolio, both on the CeFi world, but now we're actually diving deeper into the DeFi world, offering those services to DeFi protocols and on the lending side and on the trading side.
Great.
CorPrime is a prime of prime. It's a prime of prime brokers, right? What we're trying to do, I think we're mainly trying to kind of bridge the gap between crypto and traditional finance. We're trying to attract traditional capital and basically help investors in TradFi enter the market in crypto, right? So then what we're doing, we are offering them a platform where we can manage the risk associated with basically entering this space. And I am the head of risk analytics, so basically that's pretty much what I'm focusing on.
And as the audience could probably already tell, today is going to be a bit of a wonky episode, my favorite kind, going into the ins and outs of risk management and thinking about how to handle it from both of you have traditional finance experience historically, as well as now spend time in the digital asset industry. And so it brings a unique perspective, I think, for risk managers out there in the space. And one big thing that's been a struggle in the industry is setting the right LTVs. And what that means for the audience is your collateralization levels, whether it's DeFi, CeFi, whatever it might be. How much can you borrow? Where do you get liquidated? Those types of things. And so Mihai, I'd be curious how you think about that problem from a data-driven approach.
Right. I think you said there's been a challenge. I don't think necessarily there is a challenge even in this space. I think there's enough data to make it not a challenge. What we do at CorPrime and what we've I think what's been done in the TradFi as well. Setting LTVs, basically you want to set a level that would make you comfortable in case the counterparty defaults, and in case there's a market crash, then you would have enough collateral to kind of withstand those scenarios, right? So then, not to be too technical, but if you have reliable market data, reliable price history and returns of assets, you can come up with a reasonable LTV based on the simplest way on historical data, right? So then you look at let's take an asset, Bitcoin, right? Look at the historical performance of this asset, right? And you can look at a certain specific confidence interval, let's say 99 percentile, and then let's say I'm having 5 years of historical data on Bitcoin. I'm calculating returns. I take that time series of returns and I'm looking at the 99 percentile, and that would tell me I am confident that within this confidence interval, I would expect that particular value at 99 percentile would be my loss, right? Like basically, let's say if there's 25% drop and that's at 1 percentile in the tail, right? Then that would be the loss that I can incur. Based on that, you can calculate your LTV. LTV is basically 1 divided by 1 minus the loss, which is basically, actually, no, that's the collateral margin. The LTV is 1 minus let's say the 25%. That's 75%. That's your LTV. If you want to derive the collateralization, that's 1 divided by 75. That's 133%, right? So then 130%. That's basically what you just did here. You came up with a collateral level. So when you extend the loan, your counterparty should post collateral to you 133% of the principal.
Yeah. And so I think, so, you're taking a downside scenario analysis based on a historical time series.
That's correct.
And then do you think about that? And Asaf, I'm going to have a separate question for you in a moment, but just diving real quick into this, Mihai, but then how do you think about the different levels though? Or do you not let's say you have a situation where you're setting an initial collateral level, a maintenance or a margin call level, and then maybe you're also setting a liquidation level, for instance.
That's correct, yeah.
Are you doing the same math, or how are you thinking about the different levels in that approach?
So the way I think we're thinking about it is you start with initial margin, it's 130%. Then you can do for analysis to come up with a margin call level, right? That probably should not be too far away from initial margin, right? So then once you have that, then you come up with a liquidation level. The way we're thinking about it is the liquidation level should be above, let's say, the 100% principal. So you do not want to kind of the market to go as low below the principal coverage, right? So you want to recuperate your principal. You would then embed into that liquidation level other haircuts, which are slippage. It's basically slippage is the market price can slide if you put on a large trade, and then there's a price movement based on the trade that you put on. There's other fees, trading fees. You can embed some operational haircuts related to your own operations as a prime broker. So going back to it, basically, let's say 133. To give you an example, is the initial margin. I don't know, 125, it's margin call, and then you would probably want to set up your, let's say, your liquidation level at 110. So, and then that would probably make you comfortable that you're not gonna basically lose your principal. You're gonna recuperate your principal when you're gonna liquidate the collateral, right? So that should cover your principal.
Yeah, and so then Asaf, one interesting thing that I know Bitpulse has is you have the ability to take a slightly different approach with more of like a simulation-based LTV optimization concept. And so I don't want to speak for you on it. I'd love to hear, what's an alternative method? So Mihai mentioned taking a historical time series, then baking in certain factors like slippage and, whatever it is, days to sell to come up with his, like liquidation levels from there. Like, when you think about your LTV optimization, how do you think about that?
Yeah, so there's the way we look at this is it's the same, but we're coming to the answer from a different angle. What we did is we built an engine that basically takes can use different kind of models, including historical data, and a model that takes that only do pure simulation based on historical data, but actually create like pure simulation. And we have a few kinds of models that do that. Every model has a different, I would say, use case and like a different way of basically looking at the risk. And what we do is basically there's two ways. One is you can ask like, here is my initial margin, the margin call level, the liquidation level. This is how much time it takes for me or the counterparty to top up collateral. This is the term of the loan in terms of like 90 days, or open term or 1 year. And then we will, the output of the engine would be the probability of different events, including margin call, liquidation, being underwater, close out of the position. And that's basically the reason why we did it that way is because we want to offer risk managers the ability to see the probability of different events, and based on the probability, decide what kind of margin requirements.
Yeah, you can back solve it.
Yeah.
Yeah.
And then the other way, or a more interesting way, is define a risk appetite that you're okay with, and then decide how much slippage you want to leave to yourself. So you don't want to liquidate at one to one because there will be slippage and you will lose money. So where is the liquidation level? And we do have a model that basically helps you get the liquidation level. So let's say it's 105, 103, whatever. And then you have a risk appetite. You can say, I want the initial margin and margin call level to get to a 3% probability of liquidation, for example.
Yeah.
Or probability of margin call, whatever it is that you want. And then the output would be the initial margin should be X, the margin call should be Y. And another nice thing that we added is the ability to have multiple assets as collateral weighted. So basically, if you have a portfolio margining and you have X amount of BTC, X amount of ETH, X amount of SOL, whatever, you could put that in a basket of collateral, as a basket of collateral, and basically we take that, we run the analysis on that. So that's also something that is very unique, and there's a lot of demand in the market for that.
Yeah. Yeah, I think it's interesting because you can see the probability of certain events happening is obviously very interesting. But then also, okay, if I'm okay with a 5% chance of liquidation or a 0% chance of going underwater, according to your model, what would be the LTV I should charge for that then? I think it's an interesting two different approaches.
I mean, one leads to the other, vice versa. But like, I would say, how would you quantify the probability that you're comfortable with? Why would you say you're comfortable with 1% probability of liquidation, or like 0.5, or like why would you say that? Like how would you come up with that reasoning? So the way I'm thinking, what is the probability of liquidation? It's basically the number of occurrence you simulate, right? You do those simulations, you probably run a Monte Carlo, right? So then you run, I don't know, 1 million simulations, whatnot, right? You come up with a number of times. Let's say if I set up my liquidation level at 110, right? Then within those simulations, how many times that 110 level had been hit? Like, and then that's divided by the number of scenarios that you simulate. So that's your probability of liquidation, right? So then I don't know, whatever that comes to. So that's how I'm thinking, because we also calculate all these probabilities, but we do. And I think you're coming from a different angle because you are a prime broker, so we know our risk appetite, and that's only us. I think you're serving more than just one client, right? We're just serving ourselves, right? We decide on those levels based on our own risk appetite, and that's it. But I'm just curious, like if one client comes and tells you, I'm comfortable with 1% probability of liquidation, how would they think about it? Why would they say 1%, not 2% and whatnot, right? Because I would be more concerned with the liquidation level than anything else, right?
Yeah, so I would not, these are good points, and I would not look at this as what's good and what's bad. Every client, as you mentioned, has their own risk appetite, and they have their own structure of business, and some clients would want, for example, to launch like a new asset as collateral, and they would want to take risk, and they will be okay with taking more risk. They want to be aggressive to win a market. For example, this is one example of someone who would, go with like a 5-10% probability of liquidation, and another client that is a bank that would be like, we don't want to liquidate no matter what. So let's go to below 1% probability of liquidation because we want to be more conservative. So we basically give the tool for our clients to choose whatever they want. but the tool is not it's not easy to create, right? So if this every institution wants to do risk management, especially in crypto, it's very different than TradFi. So they will need to build the infrastructure from the ground up, and they will need to build models and understand the different risks.
Yeah.
And so we build it and we make it as easy as possible to integrate with. And it all started with the demand, right? I wanted to build it for myself.
Yeah.
As I was the risk manager at Anchorage before co-founding Bitpulse, and I built it because no one offered that, and it's very expensive.
No, I agree with you. We are also building our own capabilities, and it's not an easy task. So,
and so if we think about like, so let's just take an example of some of the larger, I guess, buckets of risk in the industry, and maybe we can talk about how you guys think about them. Where are the sources, the primary things that you think about with these risks, as well as like the mitigants. So if we like think about like market risk and then credit risk and then liquidity risk, we can talk about like collateral confidence risk and things like that. But like maybe let's just start with like market risk really quick. Like where do you see as some of the largest sources of market risk, and then how do you think about mitigating that generally?
Oh,
open to either.
Yeah, I mean it's a very good question, and there's those risks and there's other risks, operational risk, which I think it's a real challenge in the space. But from my perspective, the way we quantify, we quantify market risk, liquidity risk, credit risk in one kind of a framework. So let's do market risk, right? So where is that coming from? Obviously the market, right? Like we're looking at historical returns. We can go beyond that. Obviously, we can kind of create extreme loss scenarios, but the risk would come from asset volatility, right? So then, now as a prime broker, we manage the collateral. The collateral is posted in crypto assets, so we have to manage that type of volatility. If you have a basket of more than just a couple of crypto assets, then that needs to be done in a very, very specific way. You need to capture the correlation across these assets within the portfolio. But coming down to your question, it comes from collateral valuation, right? And that would be the market risk. The credit risk is, again, another major challenge in the industry is the counterparty credit risk. Like it's the risks that's associated with your counterparty. You extend the loan and then they post the collateral. If the loan is over collateralized, like we discussed, 130% at the least, right? Like we can be more than that. Then maybe you're fine with it, right? You're fine, and you're comfortable that you will not lose your principal. But if it's an under-collateralized loan, then you would be concerned about your counterparty defaulting, and that is, like I said, I think it's a challenge because the way you would measure a probability of default for the counterparty, I think it's kind of twofold. You do a due diligence on the counterparty. You look at their balance sheet and you calculate different leverage ratios and kind of like current ratio and debt to asset ratio and whatnot. So you come up with those values. You try to understand if they have enough liquidity in case something happens. They can actually post basically pay you back the principal, right? So you're trying to understand this, and let's say once you calculate a lot of ratios, then that's I would say a qualitative process. But once you have, let's say, a lot of ratios that you kind of collect from their balance sheet, then you can feed those ratios into a modeling framework that can calculate
for like credit scoring effectively.
Right. It's basically what I describe is it's a scorecard, right? Which I think everybody uses in TradFi and whatnot. But then once you have those kind of ratios, different characteristics, you can kind of come up with some measures on the quality of the management, on the kind of the level of quality of their kind of cybersecurity. Then those kind of become variables that you can feed into a model to come up with a probability of default, right? So then it just kind of streamline a counterparty default probability into one kind of number, and then that you can use. So there's, like I said, this is a challenge in the industry. There's not too many vendors that can actually calculate that probability of default. Is mainly because a lot of participants in the market are not very transparent. It's hard to kind of obtain counterparty's balance sheet at the granularity that you would be comfortable with. It's also hard to understand, even if you have the balance sheet, what is their exposure with their own counterparties, right? You cannot really see all their trades and where they are exposed anywhere else. So I think that's a challenge across, even
when
in
you have the risk
sometimes.
of fraud too, right?
I mean, everything, right? So you need to kind of get comfortable with management. You need to kind of get comfortable with the organizational structure. There's a lot of things that are very qualitative, and you know.
And so how important to you guys is like asset verification during part of that due diligence process?
What do you mean?
Like, so I know when I was, in traditional finance, usually we tried to have a certain level of asset verification for a balance sheet, and there was significantly less fraud, still fraud, but like significantly less than in this industry where, in some places it's the Wild West. And so when you're taking a look at a counterparty's balance sheet and they're giving you, we have, I guess it's easier with liquid assets, but maybe just in general, like, do you think about things, and maybe also this is maybe when you were at Anchorage or anything, like, do you go, hey, I should verify at least 30 or 50% of these assets that they're claiming that are there on the balance sheet in some way, shape, or form?
So in crypto, I would say you need to verify more than that, like 90%.
Yeah.
The problem with this, companies that gives you like, it's getting better, but like 2022, if I go back there, it's all about, you get spreadsheets, you get just papers with numbers, not audited, no administrator verifying any data.
Consolidated half the time,
from experience, like I got even like a letter, hey, we are managing X amount of billions, signed by the company. That's it, right? Now give me credit.
Yeah.
If you have a company and you manage risk, right? The company has a balance sheet of its own, has a risk appetite of its own. Each company has different balance sheet, different risk appetite. So the way I would look at managing this kind of risks, credit risks in particular, that it's how much money can I afford to lose as a company and, get a slap, but, survive and learn and go. And
maybe keep my job, yeah.
Yeah, it's not about my job. Let's talk about the company as a company.
Yeah.
And, there are the employees, there's like, you don't want to lose the company for one bad client or two even.
Yeah.
So when you have that number, now you need the tools to manage the risk to get to, in the worst case, black swan scenario, that would be the realm of where you're going to lose, how much money you're going to lose. Yeah. And now obviously no one likes to lose money, but markets are crazy, and sometimes you would lose money, and it's fine.
And if you over collateralize, then, and if you calculate your LTV properly, then you wouldn't lose money. So then it comes back to the first question, right? So over collateralize, normally if you set up your levels right, you'll be fine.
Yeah.
But
but there's still the operational risk. There's the custody risk.
There's that too.
Yeah.
I would say a very good point you raised, because if you have a counterparty and you want to see their balance sheet or NAV statement, like usually, ideally, it should be obtained from a third party that most likely audited those statements, and then you would get comfortable whatever they report it's fine. That doesn't really happen as often. It happens more often than it used to in this space. But I would say what you want to get comfortable with is, like I said, you want to get comfortable that you're going to be paid back your principal. And how you do that, you want to kind of understand the liquid assets that are on the balance sheet. Now, that's a challenge because what does liquid assets mean in crypto, right? It's different than what is been defined in TradFi, right? Like,
and there's the whole debate about
right.
proof of reserves, but that still excludes the whole liability part of the equation.
Yeah. Right. So then, like in TradFi, like TradFi is highly regulated. Like Basel says, crypto assets are not liquid, right? So straight up, any crypto assets are not liquid assets. Well, like I think we should be thinking differently about it because if you have a balance sheet that has mostly crypto, then you need to kind of make your mind up about what's liquid or what not. So the way we go about it is we go line item by line item. I'm trying to understand if you have a line item that says Bitcoin, right? Like, is this where the questions that we would ask is, where is this asset being held? Is it in a hot wallet, cold wallet? Is it staked anywhere?
Right.
If it's staked, what is the
daisy chain of risk?
Right. What's the redeem period? And not only Bitcoin, but there's a lot of assets that can be staked in the protocol, right? So then we're trying to understand how long would it take for this asset to become liquid, in case we need to be paid back, right? It needs to be transformed into USD or whatnot. It needs to kind of be posted to us as a principal to cover the loan principal, right? So that's kind of the level we're going through. And like I said, it's a challenge because I think you can go through all this, but you still won't have the visibility on your counterparties, right? They might have trades open with their own counterparties, and that's a challenge as well. So,
and statements are point in time too.
Exactly. Yeah. So
there's another point you mentioned about where you go from when you talk about liquidity, and then you go about where the liquidity is stored, which custodian, which wallet, which whatever, and then it brings another important point, and it's a new risk that is coming to our markets, which is all this BTC stables and ETH stables, and it's even dollar stables, where there's so many now, and each and every one of them has millions of liquidity, allegedly, right? I'm not saying like it's all a scam or not a scam, but it's what I can tell you is that we're diving deeper. We're doing a deep analysis on these kind of assets, especially on the BTC staked BTC assets, and trying to find out like the real liquidity. So there's the on-chain liquidity side, which is really not easy to calculate and to get, because each pool, each chain, each layer has different way of calculating, from Uniswap v3 to Uniswap v2 to Balancer to Curve, like 2 asset pools, 3 asset pools, 4 asset pools. Like it's just a huge rabbit hole that we are very deep in that hole.
And so what are you actually doing? Like, what are you looking at? What are you trying to prevent? Or are you trying to give advice to people? Are you like what are you as you think about this?
So basically, at the end, like people ask us, hey, can I accept this asset as collateral? It's a derivative.
I see.
It's a derivative of Bitcoin.
Yep.
There's Bitcoin behind the scenes, right? Like there's real Bitcoin.
Yeah.
So can I treat it as Bitcoin?
Well, it's like staked ETH or anything like that too. Yeah.
Exactly. So then, okay, so how do you get the liquidity at the end of the day? Like if you actually need the liquidity to sell it to a different asset, how do you get the liquidity?
Yeah.
So there's on-chain, and what's trading in DeFi protocols like Uniswap, Balancer, Curve, all those guys. And then the problem is that it's, if you go to data provider, no one has that data. No one has like the real liquidity, real TVL. Like they give you like the TVL, but that doesn't mean anything. Like like what's there? If I want to take out 10 Bitcoin or 10 WBTC out of Solve BTC, is it there? Is it actually there? So the TVL is, both the WBTC side and the Solve BTC side, for example. So do you actually have the WBTC there, or is it just Solve BTC, the TVL, right? It can happen, and I saw it happen. So that's one thing, right? We go on chain, we build ourselves all the adapters to each of these pools. We use from direct RPC calls to data providers. Some have some data that we can use to subgraphs. So that's one. And then we also look at the mechanism of redemption, where, for example, who is the custodian behind the scenes? Is it trustless? Is it a centralized custodian? And then the redemption mechanism usually takes time. There's a lockup period for security reasons. So is it like 3 days, 1 day, 7 days? Most of them would say it's near instant, but in their documentation, you will see that it's up to 7 days.
Yeah. It's never instant, right?
And someone is saying, yeah, we have an instant, you can instantly redeem pump BTC, for example, to WBTC, right? They say they have it in the documentation. There's a link. There's a portal that you can actually do it. But then if I look in the actual liquidity on chain, there's like 5 WBTC available only, right? And so obviously it's not instant, right? So there's a lot of risks there. And, we're talking about like there's billions now in BTC-Fi, Lido, staked ETH, it's like 20 whatever billion. That's actually pretty transparent and safe to use and also redeemable pretty much instantly.
Yeah.
But it wasn't in 2022, and you saw the DPEG of staked ETH on Curve.
Yeah. And I guess like, like for either of you guys, like, how do you kind of explain and walk through the risks, and how does a risk manager, like what you guys have done, think through those processes? How do you think through the mitigants? How do you think through like what are the downside and upside scenarios? So if I'm Joe Lender and I come in and I don't know anything about risk management and I'm saying, hey, like, should I go into Aave? Why shouldn't I, or how should I think about the risk of this? What would your guys' answer be? And maybe Mihai, you could start and we can come back.
So we're talking about DeFi protocols now, right?
Yeah.
So like at CorPrime, we don't really dabble in that, not yet. But I would say, so I see a few different risks here. So like you have one risk associated with whatever assets you're kind of trying to get into, right? That's one risk. And there's the other risk associated with the pool itself, right? So each pool has different kind of methodology to rebalance that particular pool. Like you have the constant product formula, which is the classic way, like Uniswap, they kind of introduced that. The other pools like GMX has got a totally different approach, a Hyperliquid, right? So then I would say you got to be aware of, like I said, the risk associated with the asset itself, the risk associated with the liquidity within the pool. Maybe you can kind of add to this, but that would be the first step. And if you want to measure the risks associated with these two kind of aspects of that I've just mentioned, then the risk associated with the asset is one way to do it. It's, I would say, the classic way. Kind of look at the performance of the asset and try to understand market drawdowns and whatnot. And then the risk associated with the pool itself, I think you need to understand very well how the pool is being rebalanced, the liquidity within the pool, and that's something you should probably pay attention to.
Yeah, and there's a lot that goes into that too, because it's like how well are are the smart contracts coded? Like how do you what pricing oracles are they using? Like you're exposing yourself to a lot of different.
Right. Yeah. You have the oracles as well. Yeah. So that's
there's definitely a lot of risk, and you touched on very good points. I think from first, like there's the proof of how long the protocol is alive, right? How like Compound, Aave, these are battle-tested protocols, for example. So that's something that would look at exploits, past exploits of protocols, and how the team reacted to those exploits. Then there's the actual security side of it, the way the contract is being, the way they deploy the contract. So usually, like the big protocols would be audited, and not one, it would be multiple. And usually these audits will have risks that they identified and the recommendation for the team, and then you see if the team actually implemented those or not. And then obviously there's the Oracle risk, which is a very real risk, where if the price the Oracle is sending to the protocol is wrong, basically, the liquidator will liquidate because, it's free money. And it's all based on rules, right? So it's code. It's like an if statement, and if it's going through, then you're going to get liquidated.
Yeah.
Another risk would be if you depend on liquidity, for example, if you're a lender, let's say, and you depend on the liquidator to have liquidity to actually liquidate those positions that someone borrowed from you. Mm-hmm. Obviously, it's a pool based, so you don't know who it is, but it doesn't matter. So monitoring the liquidity on chain based both like trading venues or lending venues, so you could do like a flash loan to liquidate and bring it back immediately. You need to know that there's real liquidity, right? So that's something that it's very hard to get, and that's something that we do as well.
Right, like you're saying, like, can the liquidators actually even liquidate this?
Yeah.
Yeah.
And also there's the worst case scenario where you can say, okay, can I actually take the principal out of it and go to CIFA and liquidate there? Some protocols allow this kind of transactions, but these are mainly institutions, and mainly it's basically a CIFA institution that has like a protocol, a DeFi, a smart contract. It's not decentralized in any way that operates on chain. But the beautiful thing is that it's on chain. It's transparent, so you can do it. You can get the data. It's just not easy. So first of all, you need to get the data so you can create snapshots and understand the data right now. But then you also need to monitor because things change rapidly.
Yeah.
Examples of there's multiple examples of pools that from 2 billion TVL, 1 billion TVL went to 50 million TVL in like an hour, right? So if you monitor it, then you could react fast, right? If you react fast, you don't lose money.
Well, that gets into something I wanted to ask about. Like, we talk about black swan events. You talk about like the TVL going down. Mihai, you had mentioned like let's take a portfolio margining approach, right? And now you're taking a look at, like you mentioned, okay, well, what's the historical correlation of these various assets? And then I can go and maybe, run a model and come up with LTVs and maybe adjust them dynamically based on volatility and those correlations over time. But that's all backwards looking. I forget what the right risk management term is. It's like overfitting or whatever. Mm-hmm. So like, how do you think about that?
No, you're right. It's backward looking, but that's where you start, right? You need to understand, first of all, you need to understand the profile of the asset that you're dealing with, right? So then the one way to do it is to actually understand the history of that particular asset. You can do it in many ways. You can basically have that kind of a type of history, and then if you want, you can. I would say it's backward looking, but it can inform you on kind of the future performance. You can either model future asset returns by using historical data. What you do, you assume that whatever return you've had in the past might happen in the future, right? That's one thing. How do you get comfortable with the heavy tails of that particular asset? Like, let's say if the asset has dropped 25% in the past, is it going to drop in the future as well? It's like, so you can either model it running a Monte Carlo. Basically, you need to calibrate your kind of data by using the historical basically historical distribution, right? So if it's usually assets, crypto assets are T-distributed, so then the way you would do it, you basically generate returns using the distribution that you see in the past, right? So that's how you kind of like create a new distribution, and that's your Monte Carlo, right? So then it would be a T-distribution. Then you can do that. You can just use straight up historical values. The way we would do it, and it's the simplest way, is when you just simulate using the historical returns, basically you don't assume any distribution. You just use those returns. If you wanna kind of be conservative and you want to kind of have scenarios that are most extreme, then maybe what you could do is going further back in time. Let's say if you look at past 5 years of historical performance of an asset, then I would say I would be comfortable that whatever market drop has happened 5 years ago most likely would not happen in the future. So then suddenly, and I'll tell you why I think that, but then suddenly, if you simulate using 5 years of historical data, then I would say you be conservative. The reason why I say whatever happened 5 years ago is probably not going to happen in the future is mainly because 5 years ago there was a different profile of the market. There was less liquidity. There was more volatility. Now the situation has changed. The more institutional investors are into this space. So then less volatility. So if market dropped 50% 5 years ago within 24 hours, most likely that's not going to happen going forward. So therefore, your scenario of 50% drop of Bitcoin within 24 hours is suddenly, it's a conservative scenario, right? So then if you want to be conservative, as I think we want to be, then you would use that particular scenario, and that would inform you on initial margin. That would inform you on your collateral valuation and whatnot, right? So that would be another way. But again, like I said, you can do it in many ways. You can run a simulation, Monte Carlo simulation. You just have to be careful to kind of pay attention to the distribution of the asset and whatnot.
So then would you guys say that, like, when you have, all right, let's say you're going to take a new asset as collateral then. Mm-hmm. Is the answer then really not just its historicals, not just the data, but like kind of, hey, you need to go diligence this project individually, because to try to come up with some way to quantify or even qualitatively think about the go to zero risk. Like we take Luna for an example, like the historicals in that would not have told you that it's going to gap down to zero. So, like how would you have thought about that?
Well, we wouldn't have taken Luna.
Well, yeah, okay.
But yeah, you're right. Yeah. I think from my perspective, we are trying to be conservative. We are trying to stick with assets that are
have a historical track record, high liquidity,
have historical track record, and they have like significant liquidity in the market. And we're thinking, I don't know, top 10, top 20 crypto assets. I think that's a good approach, and that's also kind of that's also the fact that you're thinking about it like that. It's also a measure of risk management, right? It's part of it, right?
Well, you can't be a good lender if you don't at least think about the risk.
Yeah, I would not want to take collateral. I don't know, like Trump coin, for instance. Maybe
Yeah.
I would say so. Luna is actually, it's a good example of, like, if you actually understood the mechanism of how UST worked, like basically the collateral that was backing UST was Luna, and the mechanism is to print more Luna if the price drops. And basically what you saw is what happened to the dollar on steroids. So it's like you print more, then it's just worth nothing, and that's inflation on steroids.
But you would have found that in the diligence project of the actual project, right?
Yeah,
You wouldn't have just taken a look at the values over time. You would have had to actually figure out what's going on.
Yeah, look, every asset, doesn't matter which asset, you could look at the books, look at the liquidity, and say, okay, this is what I can accept. And then I think something that happened with Luna is that people did not sell. Like, people did not liquidate those positions. And then when it actually crashed, like because of the fail of the mathematical mechanism, everyone started liquidating because it was, let's save at least 5% of my position or whatever.
Yeah.
In general, it's every asset, like Trump coin, for example, I would not recommend taking it as collateral, but if you look at the liquidity and it's trading,
you guys could run your models and it would spit out a number, and then it's a question about what is do we actually do this, right?
There's also accepting is one thing, but how much can you accept is another thing, and also
right, there's like liquidity and just average daily trading.
Maybe you can accept, like you probably would feel comfortable in accepting a few $100,000 of Trump coin, right? A few $100,000 worth of Trump coin. To tell you to do it, I would probably not recommend it. I can run the models and see like how it reacts. There's not a lot of historical data, so we could basically either attach other assets that are similar in nature, ways, a lot of speculative.
Yeah, high volatility, low history assets.
Which will not give you accurate data, but it will give you some insights.
Right, because you could proxy, you're saying. The ones that have more of a trading history, that has a similar volatility profile, you could try to proxy it.
Yeah, but in general, if you have the right tools to monitor deep liquidity and you can react fast, like you have the right infrastructure to react fast, and you can accept almost all of these assets. This is what market makers are doing, right? They're on the markets, they're trading these assets, they have short-term exposures to these weird low cap assets, and it's doable, but it depends how sophisticated you are, and in terms of when you see that something goes wrong, like how fast can you react? Like if you're a retail or like a slow money entity, then you should basically not deal with these
you shouldn't be touching
dangerous assets. You mentioned the 50% drops like from 5-6 years ago. That I agree with you.
I don't know if it was 50, but
no, there was like crazy amount. Like it was like 30% in like 10 minutes.
No, it's. I mean, what is it?
March 2020,
like
right?
our old colleague Alex Thorne had a thing of like Bitcoin's largest drops, and it's a lot. It's like in the 70s sometimes. Like it's been.
That's maybe like
20 years.
How far you want to go back, right? Like it's.
Well, right. Yeah.
But look, look at ETH like from a few weeks ago. Like it was crashing like.
Yeah, but where was that? That was what exchange was that?
It was many exchanges.
How many? Because I think it's just one or two. Like I don't think it was too many. So what I'm saying is like that would be the way.
That's the point, though. That's what my point here is that
But that doesn't represent the market of it. That's what I'm saying.
On TradeFi, right? If you go to an exchange, there's circuit breakers, and on CeFi DeFi, you don't have it, right? Like it's, there's no liquidity, and someone is selling, and it's going to drop to whatever price, wherever is the bid, and it doesn't matter the price. Like if you have the margin position on that exchange, you will lose money.
But okay, it's fine. I get that, but that does not represent the value of it, like market wide, right? Like so.
No, I agree.
That is an exchange specific liquidity issue. That is basically. I mean, flash crashes like that happen, and what I think from my perspective, if you want to measure performance of it, you probably would not want to look at that particular instance, right? That's an outlier that if you want to risk measure the performance of the asset, you should take it out, because it doesn't represent its performance. It reflects that particular exchange whatever issue they've had, the liquidity, whatnot. I don't know details, but like, and I think we're coming down to like the pricing providers, because when you measure risk on these assets, then you need to kind of have a reliable pricing provider for these particular assets, and that would basically, the way I'm thinking, should aggregate the value of that asset across multiple exchanges. Would exclude liquidity specific issues, would exclude flash crashes. I don't think they reflect into it what it is as an asset, right? Or like any other asset.
Yeah, I think in the long term it's not reflecting. In the short term, like it can reflect. The arbitrageurs would come and do the arbitrage, and the price will drop. Probably not 30 or 20 or like that amount of percentage.
Yeah, but that's the exchange specific issue, right? Otherwise, you would see it everywhere, right? That's what I'm saying.
I agree. I would say that it can happen at every exchange, though. Like every exchange that these exchanges are not regulated, even Coinbase.
Well, doesn't part of this, like, I feel like there's like a two-part thing to what you guys are saying, right? Like if you have your docs or it's something on DeFi, and like you're for some reason leveraging that exchange's price feed in your models, that may not actually be the true value of the asset. If you had taken an aggregation, but it's going to trigger real economic effects for you anyway, because your thing just sent out a liquidation order. But it's also like, I guess then there's the other problem of, if you as the lender, for whatever reason, like can only transact on that exchange and you can't go OTC and you can't go to any other venue, I guess then maybe it would be relevant, right?
Yes, it would be. Yeah. It would be relevant then. Ideally, you want to deal with exchanges that would not have that.
Maybe onboard to more than one.
Right. But I think for a lender like us, I think we want to capture a objective market level of the asset that we hold as a collateral. There's this pricing providers out there that provide that level. Coinmetrics, Kaiko, these are like, from the top of my head, two of the better ones. And I believe you guys, Membrane, you use Coinmetrics, right, as a pricing provider.
Yeah, we have a bunch.
Okay,
I don't have the list off the top of my head here.
So I would say for risk management purposes, you want to use an aggregated price. I think Coinmetrics they call it reference rate. So they aggregate a price, the pricing level across most major exchanges. They weighted average on traded lot size, right. And so they're approved by IFRS. So I think they do it right. But if you're exposed to a specific exchange, like you've mentioned, then yes, you probably want to have an idea where you would be able to liquidate that, and maybe
it's a bit of an edge case scenario.
Maybe you want to use that particular exchange price level, right?
And so, I think it might be valuable. We've talked about market risk, credit risk, variety of other risks, honestly, but like let's dive in a little bit on liquidity risk outside of a DeFi context. Maybe we start, Mihai, how do you think about that?
I think it's a good point. I think in centralized finance, there's a big difference. I think there's a big difference between DeFi, CeFi, right? I think the gap is closing. I think DeFi is becoming kind of getting close to the way CeFi has been in terms of liquidity, is getting closer to CeFi. The way we're thinking about it is, I think we've mentioned about slippage. That would be a main kind of component, part of the liquidity risk. The way I would model liquidity risk is basically looking at the market debt, which is more prevalent in CeFi, and you would understand the bid offer, the spreads, and then you would understand you can actually come up with the calculating your slippage. Now, going back to DeFi, there's actually tools out there that can give you that slippage. I think DeFi Llama has a tool where you can just input the trade that you want to do, and they spit out a slippage. I think Uniswap has the same kind of tool approach, but I feel for us as a prime of prime brokers, we need to come up with our own kind of estimation of slippage, and that's what we're working on. And we would be using most likely centralized exchange data because, like I said, they have the good market depth data. So that's the way we think about it. Like I said, in the final calculation, when we calculate the exposure of our portfolio, that slippage would be a value that would be incorporated in our LTV, initial LTV, right? And that's kind of where it starts, and obviously being monitored going forward.
Yeah. I think we talked about the DeFi part. DeFi is more complex to understand, like the impact of like a big trade. So you need to understand each and every mechanism of each and every pool in order to actually calculate it. Today, there are not a lot of good tools. There are some tools that are kind of accurate, but they're not like,
Are you saying cannot... in DeFi right now? You're saying? Yeah. Okay.
And then if you go to CeFi or to centralized exchanges, then you'll see that it's easier to there's an actual order book, right? So it's easier to see that, like, to go through the book and see the liquidity, and you can estimate your slippage. You can also go to those order books historically and see in times of stress what happens to that slippage, and going through those and doing this kind of analysis would help you set your liquidation LTV. So you can go to the worst case market condition or very bad market condition to define, okay, this is like a good
case liquidity or something.
We actually have a model that you could basically, one of the inputs is basically you write an exchange, like a venue. You write the actual assets pair that you want to take liquidity from, and we will take those. We can have add 20 different exchanges if you have access to those exchanges, and then we will run a liquidity analysis using that, using your available markets. So if you have only 5 exchanges because you're in the US and Binance and Bybit and all these guys would not onboard you, then you only have Kraken, Coinbase, whatever. Gemini, whatever. And so we could actually analyze it for you. If you use global liquidity, then we can analyze that as well.
Yeah. And do you guys ever, and this might honestly be a really dumb question, but do you ever think about, or is there even any way to look at non-exchange venue liquidity, like ECNs or the OTC market? Does that ever come into how you think about it?
As long as, look, if you get the data, for example, most of the OTC desks will stream prices, and they have historical streaming quotes, right? So you can get the data. If you have the data, you can incorporate that data into your analysis.
Would that be reliable? I don't know. I mean, at least for your purposes, it could be.
It's reliable if you use a third party.
It could be very specific if you want to use it or not. But
At Anchorage, we used to do it. I'm not going to mention names, but we used to do it. But we actually get the stream. And we capture the stream and we save it.
You're not a service provider in that case. But you're the actual counterparty. So it's a little different.
But if you have the data, you can incorporate. So, for example, if you have data that you want to use our models with your data, we can do it as well. That's another example.
Yeah.
And I also think if you think about the history of risk management, even in TradFi, it's a kind of a function that is not necessarily revenue producing, right? So it's always been kind of understaffed. I would say, I wouldn't say underappreciated, but at times it hasn't been kind of regarded as it should.
Yeah.
And only moments like, I don't know, the crisis in 1991 when VAR was created, think about 2008 when a lot of other risk kind of a management metrics have been also created. Those are kind of the moments when people understand how important risk management is. Other than that, when marketing is on up and up, then nobody cares about risk.
People yell at the risk guy.
We're just making money. Why would it?
No one likes the risk
Why would
guy.
they invest in risk management?
I think any good lender, trader, risk needs to be your partner. And I think but I also think like people have sometimes there's an adversarial relationship, and sometimes it's just one side for the other. Like I always used to try to be. Full disclosure, Mihai and I used to work together, and if in a good relationship between risk and the traders or the lenders or what have you, you can have great things can actually happen in a smart way. I think, but sometimes you have incentive structures where risk folks are only incentivized for. It's a tough thing because you don't want to incentivize them to take more risk, but then at the same time, if their only incentives are disincentives to making bad deals, then they're just going to be super conservative and say no to everything. And so I think it makes it hard. So.
It is. And like traders, the way they view their own risk is very different the way a risk management department would view the risk across the firm overall, right? So then you're always kind of at odds with traders because they see risk from their own lenses and it's very kind of subjective.
Yeah. I would say that a good trader is also a good risk manager. And, I started as a trader. I was an options trader for a decade. And, options is like taking risk. I had a risk manager. I was my own risk manager as well because you don't want to lose money, right? And, it was like the switching from a trader to switching the hats and be on the other side of the table and start saying no to people. It's hard because you are like people don't like the risk manager. Like usually, like you're the guy who like bums everyone. Like you cannot do that. That's it. And then you can be a hero for like a week or two when
but it's also a daisy chain sometimes because like I've actually found, having been a lender historically, like you sometimes sit in between risk and sales or risk and like and then it's like then I'm also the one telling them no and why.
But as a trader you're concerned about your own book, right? You don't care about anybody else's book, right? Like so you do manage risk, but for your book.
For your book only.
Like other people, other traders' books. What do I care? But then a risk management department like basically looks across above everybody else, and like it has a different view than what you have.
A different view, and I would say, being on both sides, it's much more interesting to be.
I think this is really insightful, guys, and like it's something that no one really goes out and talks a ton about or in this depth and level of detail, especially in the institutional space in crypto with folks that have done it in traditional finance before. And, I said it before, but I'll say it again. I think that this is really insightful. I really appreciate you guys. And for the listeners, if you are a prime broker and you're looking for some lending, you can give Mihai and his team a call. And if you are any institution really that's looking to optimize their LTVs, run scenario analyses, Asaf and the great team of Bitpulse offer a phenomenal service that, otherwise you'd have to hire Mihai and build it yourself, so it's a, Mihai or Asaf or whomever, guys, it's you both have, done great work and, and I know that us and the listeners really appreciate it. So thank you again.
Thank you.
Thank you.